Good morning. I know we're the last panel keeping you from your lunch, so we'll hopefully make this interesting to keep you hungry. I'm joined, well, we are lucky to be joined by a distinguished panel made up of gentlemen who are advisors, policymakers on the broking side and on the buy side. So we have a broad range of interests and expertise with the panel. We have a lot to talk about, so apologies. We'll crack on. The first topic I'd like to raise with the panel is a very broad one, but it filters down to pretty much the rest of the topics that we have under discussion, which is what, in the panel's view, are the current major challenges facing firms across the industry, both on the buy side and the sell side's chief compliance officers. James, do you want to kick off?
For chief compliance officers, I think the first thing they got to be worried about is their own personal liability. After Dodd Frank, then on the future side, MF Global, PFG, there's just been a slew of new rules and regs out there that CCOs are charged with complying with, and a lot of times they have personal liability. I mean, if you look at some of the new procedures NFA, for example, put into place, I personally wouldn't want to be a CCO in that environment. But just understanding all these things, getting them implemented by deadlines, they have a brutally tough job right now.
Thank you. I'll leave aside the policymaker, obviously, because you're on the wrong side of this. But is there what would you like to add to that?
So I basically say the same thing. I mean, one of the difficulties about trying to bring this into the fold is that you not only have cross regulatory issues within the SEC and CFTC, but you also have cross-border issues within the rules and regs and how to bring all those together. So it really presents a unique paradigm in terms of understanding which rules and regs in the different areas apply to your particular firm. And I think that's been part and parcel to a lot of the problems faced with some of the uptake in the volumes, is really getting the compliance procedures and policies intact. And many of those, by the way, are still unfolding and will continue to unfold for the next few years.
Indeed. John, if I can come back to you a sec for the Canadian perspective. But John, you're helping out chief compliance officers and firms at the moment on various aspects.
Right. We just did a filing with an FCM for their first CCO report, and the scope of this covers both FCMs and swap dealers as well as DCMs, exchanges. In terms of that similar obligation to the regulators. But we went through with an FCM. They poured all the rules, mainly the CEA and other rules, into a tool that they acquired, and we filtered out those rules that were not applicable to their business line. And then we had to go to each respective department, whether it was risk or operations or client services, and interview some of the key managers and say, how is the firm complying with this rule? We had to get evidence that the firm was or wasn't, and that rolled up to a dashboard that ultimately the chief compliance officer compiled a report, which he had to take to the board of directors of the firm to get their blessing. This is kind of akin to what you'd have to do with Sarbanes-Oxley if you're a reporting company. And then they filed it with the commission in February. That organization, their fiscal year ended in November. And everyone else on a calendar year, their reports were going in the end of March. So the CCO was calling around to his friends and colleagues saying, what are you doing, and what have you started on this, and what problems do you have, and how many pages are you putting in, and things like that. So pretty onerous, but the fact that they've done it once helps them greatly for the next time around.
And my question before we turn to Rajeev, the policymaker, John, are you seeing the same thing from your point of view of the rest of North America?
Yeah.
Put it like that.
The Canadian regulators, I think, they've done a pretty good job. We have a lot fewer market structure issues that you have down in the U.S. The biggest challenge we have north of the border comes with trying to avoid any kind of regulatory arbitrage environment, and also competing for order flow. You call maybe 300 of the top most liquid names in Canada. Over three-quarters of those also trade dually listed in the U.S. So the challenge that the regulators in Canada have and the exchanges is trying to fight for that market share. We've seen that drop now to below half, where a majority of that interlisted flow now is happening in the U.S. So trying to compete, trying to manage the regulatory environment, but also compete in terms of market share.
Thank you. Rajeev, coming finally back to you. To take a couple of the points here, where we've got chief compliance officers and boards who are responding to queries and filing reports that they're obligated to do. You've got firms who are maybe trading in the US on US markets but regulated elsewhere. Do you have a sense that the regulators and the regulations themselves in the US are sufficiently developed and concrete that we can know before we file and get a response how bad things are going to be and ultimately where the responsibility may fall for what?
Okay. Before I begin, I would like to put out the disclosure that these are my views and not the Federal Reserve or the Board of Governors. Well, some of the issues that John and other people have mentioned, also with respect to other regulators, so say EU versus US, we have the distinction between, are you a US person or a non-US person, right? If you go back and look at the volume statistics, you will see that there's already, the volume has, kind of gone to London. There is already, even though, the mandate that started like six months ago, when SEFs went live, and then, in February we had the interest rate swaps that started trading. Not much has changed since February that they went live, because already people who are non-US versus US have started to take a step back. There is this concept of a subsidiary of a US company or not. So they are regarded differently in US and in Europe. Okay, so that is one thing where the distinction between a US and a non-US person, a US subsidiary or a subsidiary, the concept of subsidiary is different. And then there is no differentiation between a bilateral trade and a clear trade.
Yep.
They're both being considered as one, whereas they are actually two distinct kind of trading done. When we all, from futures markets at least, know what a clear trade is,
Yes.
how is that regarded with margins and everything else. But that is not distinctly recognized. So we will have other costs going that way. That will be an issue. But US, non-US, that is another issue. There is in Europe you have reporting requirements that are coming up. That is again going to be a challenge, I would say, because there are other requirements where they in Europe they're expecting that the collateral also be reported. There's already a two-way reporting. If you are the buyer and you are the seller, it doesn't matter. You have to report twice. So there's already a reporting problem going around, not just in Europe, but even in US. We had, I think, if I'm not wrong, Scott O'Malley mentioned that we need a real-time, or we need a next-generation reporting mechanism. We have all this data, but we don't really know what to make sense of it. So there are going to be a lot of challenges going forward. US, Europe. Europe is a little behind on timeline with respect to US. So there's just going to be other changes coming forward.
But in terms of clients like FCMs who are filing the CCO reports, do you get a sense of, from a regulatory point of view, what the results of, because nobody's perfect. If you say you're perfect, you've probably missed something.
Yeah.
What the response is going to be from the regulators to imperfect situations.
Yeah. No.
James.
Yeah, so I forgot my disclaimer, but nothing I say necessarily is reflective of the views of NFA. But so NFA has spent the last couple of years implementing a swap regulatory regime. They went from a headcount of 1 dedicated for swaps in 2012 to 70 staff now, taking up to 130 people by the end of the year. They've spent the last 2 years dealing with the 4S submissions. They've taken 8,000 submissions, about 230,000 pages worth of filings have been made. Got 100 registered swap dealers, and they've got 16 regulatory services agreements in place with CEFs. So there's a whole slew of people being onboarded, and basically 3 years after they got this mandate from the CFTC, not one exam has been conducted yet. So NFA, I think, is really trying to work with the swap dealers and the CEFs to kind of create a framework where they're not going to start busting people right away due to the complexity of Dodd Frank and for all the new CFTC 4S rules. And I threw out a lot of numbers, but one kind of jarring one is the definition of the word swap in Dodd Frank is over 300 pages. So if you're even a medium-sized firm or anything outside of kind of the too big to fail banking sector, I mean, the amount of work to comply with all these regs is enormous, and I think the regulators are sensitive to that, and they're going to be looking to work hand in hand with them to make sure that there aren't rampant violations when this stuff is just being rolled out.
So going to the cost of compliance then, we've got the Johns and Chris who might be able to give us a steer on what is the future for the FCM business, what is the future for the direct market access business, given what is going to be pushed back to the FCMs and the DMA providers in terms of compliance.
So I think what we're seeing here is the regulatory framework is being laid down, and certainly from a volume perspective, volumes have been very light. In fact, I would say that there's regulatory arbitrage going on today where you're seeing non-US dealers not really transacting in the US on account of some of the rules and regs that have come into place. And as a result of that, the CFTC just recently has started back off on some of those rules, and it's also a point of catch-up in terms of getting those there. But when it comes to in terms of overall volume growth and how that's going to happen, while we have CEFs registered, there are still a lot of technologies that need to come into play from the intermediaries. That hasn't been done. There's still not a really good understanding of the quote mechanisms in the marketplace, and not any familiarity with it at all. In fact, Rajeev sent out a survey that showed on the buy side very little familiarity with that. So I think it's really what we're seeing here is a market in its infancy, but what's unique about it is that I think for the first time from a global regulatory perspective, you're seeing a lot of working together by all the agencies across the marketplace that eventually will help to bring and foster the technologies able to help, if you will, electronicize the business. None of the business today is really being conducted via any electronic channels for the most part, particularly in the US. So I think what we're really looking at is a lot of time, if you will, 3 to 5 years before we see significant uptake in that regard.
Thank you.
Well, if you look at CEFs, so just look at the normal gestation period for new products in the futures industries is typically about 2 years. So we're only about 6 months into the infancy of this new part of the business. The major interdealer brokers and some of the platform providers like Bloomberg Market Access, et cetera, if you look at stats that are out already, and if you haven't looked at them, I'd refer you to the FIA's website, FIA.org. They're putting out now monthly market share and volume numbers on the various CEFs, on both credit and interest rate swaps. So they're out there, as well as clarisft.com. But they both do a great job with that so far. But we're at the infancy of this. When the concept of CEFs came out in the Dodd Frank discussions, there were people that went out and said, well, how many are we going to have? Dozens, hundreds, whatever. There's 20 some odd that have filed. have gotten no action coverage so far from the commission on this. The active ones are the ones that have had liquidity and relationships already. ICAP, BGC, Tradition, Tullett, TradeWeb, et cetera. New startups coming in there, scratching and clawing for share. But the buy side, I think, is what I call the concept of ISDN. If you're a buyer, it stands for I still don't know. And if you're a seller, it stands for I smell dollars now. So people started CEFs to come into an attractive market, let's say interest rate swaps. And unless there's liquidity, people aren't going to trade on it. Unless there's value-added features like credit checking and some value-added content and aggregation and things like that, they're not going to get any traction. So these are some of the major issues that any new startup market, if you go, even look at going from open outcry to electronic trading, the gestation period on this is not small, it's not short.
Thank you.
Yeah, I wanted to add one other point on that, which I think is an important one. When you look at the CEF market right now, it tends to be a little bit more cost prohibitive than the non-traditional or the traditional markets have been. I don't know how many of you listened to the CFTC hearing, the Technology Advisory Committee hearing on June 3rd, just this past Tuesday or Wednesday or whatever. But it was interesting towards the end of the panel, or towards the end of the panel, they had a panel on CEFs. And I thought it was quite interesting, some of the comments that Michael O'Brien from Eaton Vance made with regards to it. They're a fairly large dealer in the space, and he basically said that their other products are a lot cheaper to trade versus trading on the CEFs. And I think that's a really, really important factor that needs to be ferreted out that just is not there yet. So the competition from the registered CEFs still hasn't come to fruition in terms of actually lowering the costs and the transparency of the quotations in the marketplace.
Okay. Sorry, yes.
I was just curious, how many people in the audience are trading swaps, brokering swaps, doing any kind of transactions with swaps right now? What percentage here? I see one hand, two, so not very many. And I mean, that's kind of been what we've seen. I mean, we're a buy-side firm. We trade primarily futures. Recently, we started trying to trade some nat gas swaps futures, which are basically futures. They're settled to a CME price every day. And the sheer terror that we've seen from our FCMs, and like, what are these? Oh my God, you're going to take a debit risk. Like, you know, risk isn't going to approve this. I mean, it's just, people are afraid of it, and it's new. And I think there's a duality there. Sometimes, you know, the newness gives opportunity, and I think to the dealers, they definitely sniff that. To the buy side, you're getting in there, you're probably going to see wider spreads, which gives market makers some opportunities. But change does take a while, and volumes have definitely been, I think, much lighter than the regulators have expected thus far.
John, I was hoping to come to you, but I think actually it may be more interesting for the audience if we can move from what James is saying towards back to the original part of what we were talking about, but move it on slightly when the liability of the compliance officer in an environment where no one's quite sure of the rules, no one's quite sure where everything's going. But from a cross-border point of view, I think in Canada and the US and in the EU and in Asia, we're in a similar position, and there's a contentious point. At least I believe it's a contentious point. All my views are personal, don't represent the views of my firm, etc., etc., etc. But the idea that there is a rule in the EU which says a trading system, an automated trading system, used by an investment firm cannot, and the word cannot is used, be used for the purposes of market abuse or manipulation. And frankly, my view is that's almost next to impossible, because that's like saying a telephone cannot be used for the purposes of rigging libel, or you know, your BlackBerry Messenger cannot be used for the purposes of organising a riot in central London. It's a very, very difficult position that firms who trade electronically or algorithmically face. And to start with a straw poll, I think maybe how many folk here in the audience would think of training their developers in a Series 7 exam in the US? That's good to hear. I'm important. Yeah, I think actually going forward that's going to be an important thing for us to do. But from a Canadian perspective, is there anything I'm saying that?
I think I'll go back to a point that Chris made earlier, is that the collaboration that you're starting to see between jurisdictions is going to be very important. And it's kind of funny from the Canadian standpoint, where you've got our traditional conservatism that, us being 2, 3, 4 years behind the U.S. In terms of market developments over the past 10 years. It's provided us a bit of insight and the opportunity to kind of watch things unfold. And as we have been developing our rules, take into consideration some of the things we've seen in other markets. It's now almost flip-flopped, and I think that, we're now, our regulators, IROC and the OSC, they have an open dialogue with the SEC, FINRA, the CFTC, and you're starting to see the US now come to Canada to look at for the models and the frameworks that have tended to work. Things like we don't have payment for order flow, our dark rules are very restrictive and transparent. What else did I put down here?
Oh, what about your liquidity facility for failure of an FCM or broker-dealer? I think that's probably the best in the world in Canada.
Yeah, it's just all these things combined where, we because we are a little bit later to the game in terms of development, it's now allowed us to operate in a framework that's, I think, advantageous and enviable from, being able to bypass some of these other issues that we're now coming to.
Actually, that just reminds me, it's an interesting point, and it's not one we discussed prior to the panel, so apologies for springing on it. But there are other jurisdictions, I'm looking towards Asia and China, who are in a better position to take the Canadian model, which is to look at how badly we're messing it up over here and in the EU, and take what it is we're doing right and building their own markets around what it is we're doing right and avoiding what it is we're doing wrong, in the same way that Canada is able to take advantage of that. Rajeev, do you think that's that presents a systemic risk to the markets going forward? Is that something that policymakers and regulators should take more notice of?
Actually, I really don't know how to answer that question, but systemic risk, I don't know. Again, personal opinion, personal view, I don't think so, but yeah, regulatory arbitrage is going to be, issues, sure. I'm not sure if that is anywhere combined to systemic risk.
Well, systemic risk as in everybody who trades on the markets in the US and the EU now just goes somewhere else.
Oh, so you mean liquidity
Liquidity dries up, participants leave. You're regulating an empty market.
No, well, I'm sure, as mentioned, we regulators are much more, they understand this issue. They understand, as I mentioned with the swaps going away to, or Europeans are trying to not trade as much in US as much they used to. So I think the regulators are understanding that, and they're trying to work in this issue. They appreciate this fact that this is going on. But I don't think, we would, again, my personal view, I don't think we would like to let liquidity go away from US.
Yeah. So someone on the buy side, James, is this something that you're bearing in mind, planning your 2, 3, 5-year plan?
Yeah, I mean, we're not actively planning to trade much in the way of swaps for the next couple of years. I mean, just basically the swap futures in nat gas on ice. But from the regulatory perspective, I think you always have to be conscious of costs, and capital tends to flow to the most cost-efficient markets. So if you overregulate, it almost always will allow capital to flee, at least at an institutional level, and that's where I think you do open up to systemic risk. I mean, like, look, we've got Reg T over here that caps leverage, pretty reasonable amount. And basically every institution has a subsidiary in London where they're able to move stuff over there and rehypothecate up to 30 to 1. And I mean, that opens up a lot of issues. I mean, that's where the whole shadow banking system phrase comes from. And you've got, I think, hundreds of trillions of dollars in notional exposure that's completely unregulated. So while I think the push to get everybody onto exchange clear swaps is well intentioned, I don't know if it's going to be very effective in getting rid of that unregulated activity.
Sure, thank you. And as a registered lobbyist, is this something that is this an angle that you touch on when you talk to Capitol Hill?
Yeah, absolutely. From all aspects of regulation, and I will tell you that even though, particularly in this market, within Dodd Frank, there was a lot of very heavy regulation that was pushed forward. From the congressional aspect and from the oversight and regulatory aspect, I think they're very keen not to disrupt and flee volume overseas. And given that the market's small right now, you've already seen some steps and measures to redact some of the rulemaking that's been put in place with respect to CEF's oversight reporting on that. And I think that was a very wise move. In fact, the CFTC just on May 22nd, a couple of weeks ago, pulled back some of the reporting rules on 1.35 with respect to some of the CEFs. So from the congressional and regulatory landscape, yeah, it's a very important consideration in that regard. Do I think that today there's regulatory arbitrage? Absolutely, as the rules are coming into the fray. But that's the case with any type of rulemaking that happens. Even with our friends up in Canada, we see a lot of that happening. But will the regulations come into place and be harmonized across the globe? I think absolutely. And I also believe that 5 years from now, the CEF market, the swap market, the transparency of it is going to be a very hot commodity. I think we're actually going to have panels talking about high-frequency trading in the CEF market in 5 years from now in the U.S. So.
Yes.
Sam, one other thing is when the winds of Dodd Frank were starting to blow, a number of major banks moved their OTC derivatives business out of the U.S.
That's right.
They moved human capital, they moved technology into business units in London and Zurich and other places, and that's where they transact that business today. And having done an operational technology review of a major bank dealer, one of the issues that bank faced 3 years ago was if they didn't get a regulatory passport between the UK and the US, they'd have to repatriate the people, the systems, and everything. That would take them a year and a half or 2 years and cost them tens of millions of dollars. And the question is, was there going to be a business for them had they been pushed to that brink? But those activities are being done not in the U.S. physically.
Absolutely. So I'm conscious that we're getting towards the end of our time, and I don't want to keep you from your lunches. So maybe we can start winding it up. Just running down this way down the panel. Actually, maybe James is a good place to start. Being on the buy side, where do you think the broker business is going to be in 5 years?
Talking FCM business?
Yeah. The FCM business.
I mean, it's looking more and more like FCMs are going to turn into IBs. I mean, there's a lot of kind of ruminations from buy-side advocacy groups to go to a quad-party segregation model where basically FCMs could potentially wind up holding little to no customer cash, and a lot of that be held at either custody banks or the exchanges. If that happens, I mean, an FCM basically is an IB that's selling foreign exchange. And I don't know, I think you will see the swap dealer side grow and the CEF side grow, and there will be some more unification over there, and I think more swaps are going to continue to look like futures.
Do you think that's a good thing? Possibly as a good handover to Rajeev. Do you think that's a good thing?
You know, I'm not sure yet. I think it's a little too early to tell, honestly. But I'm always wary of major sweeping changes, and think there could be some pretty nasty unintended consequences to Dodd Frank.
Rajeev, so is it a good thing?
Is it a good thing?
Where
Actually,
we're going.
well, personally, I don't think it's a good thing if, if you start looking at the historical number of FCMs that were there probably 5, 6 years or 7 years ago, more than I think 130 or something, and now you see they're under 100, and by the day, either going out of business or consolidating, and personally, I would like to see more number of FCMs, because again, you get into the concentration risk between the top 5, top 6, FCMs controlling most of the money there. So, personally, I would like to see more number of FCMs. So that is one. With respect to, since February, or since we, SEPs went live, we, at least in the volume, you see very little change in the number of dealer-to-dealer, interest rate swaps that were being done. So I'm not that worried. At least, I'm guessing it's going to be. There are a lot of rule changes. There are a lot of things to consider. Fragmentation in Europe is one, other huge thing that we haven't even spoken about. Costs are definitely going up. So I think it'll take some time, as Chris and other people mentioned, that we need 2 years, or at least futures have been 2 years. So if Chris says in 5 years we'll see HFT in swap market, I guess we need to give it some time to see where we stand. It's too early a stage right now, but definitely, FCM business is also going to become more competitive, considering you have, futurization of swaps. There's going to be, a different market segment out there as well. So hopefully, we see more number of FCM, but I agreed, as of today, it looks like it's in a bit of a problem.
Yeah, I'd say just in terms of the FCNs, I think as with every other market that tends to mature, demutualize, fragment, you see an interesting thing happen, and that is the consolidation of a lot of volume with certain players, but you see a lot of the other players, in order to transact on a cost-efficient basis, move upstairs, so to speak. And that really hasn't happened in this market. I think we will see an evolution of that as we start to see e-order books and much more electronic trading begin to happen in this market, which there is no electronic trading in this market today. And I think that'll open up the door for additional participation, but I do think it's an unintended consequence that necessarily hasn't been rigorously addressed in so much as how that begins to unfold.
Maybe just add just one tidbit kind of near the end here, that as the U.S. regulators look at shaping these rules over the coming months, and as we talked before, maybe looking to other jurisdictions for some guidance and ideas, that the OSC and IROC, our regulators in Canada, put out a request for comment 3 weeks ago on changing our order protection rules in Canada. And one of the key components of that, or one of the most talked about and controversial ones, is a pilot study they're going to be launching on elimination of the maker-taker model. So that's something that, given how much dialogue I think they have with the U.S. regulators, it might be maybe a bit of foreshadowing in terms of what might be down the pipe later this year. So for those who it affects in the room, it might be something to keep an eye on in Canada, just to see what the outcomes are there.
Financial services globally is under grinding margin pressure. Regulatory costs, increasing regulatory costs, increasing technology costs, low interest rate environment, so virtually no fee-based income. You look at many firms are raising the bars. Many FCMs that we know are raising the bar in terms of minimum amount of business that they're accepting from clients, buy side, et cetera. And so firms are being forced to switch their FCM. And there's less and less of a choice out there in terms of high quality and low cost and flexible providers. So the concept of too big to fail, they're getting bigger. There's less of them, they're getting bigger. We need innovation. We need choice. Our industry doesn't like duopolies, let alone monopolies. We like to have 3 or 4 of each. But again, if you look at just some CFTC data on the largest FCMs, once you pass the top 5 or 6, you drop down to the bargain basement in terms of customer assets and seg and stuff like that. So we're going through evolution, which is good. It's natural. People don't like change. It's human nature. People don't like change. So you've got to adapt. But if you're an execution-only FCM or a clearing-only FCM, you got to rethink what you want to be when you grow up.
Yeah, thank you. I think that's a good point to ask whether there are any questions from the audience. Last chance.
Everyone wants lunch.
Yeah, I think everyone wants lunch. In which case, I'd like to thank our panelists very much indeed and ask you to do the same. And we're all around if you have any questions. Thank you.